Uncertainty on the Fed's rate cut path, Trump tariffs, a jump in Treasury yields, making for a turbulent run for markets in January. What does this mean for the options market? Katara, TappAlpha CEO and founder, joining us now to discuss In the Options Pit, sponsored by Tasty Trade. Thinking we're in the options pit, surrounded. Anyways, thanks for being here. So indeed, there are a lot of cross currents right now, and we've seen an uptick in volatility. What kind of environment is that for an options trader?
It's interesting. It's sort of an ideal world. First of all, thanks so much for having me. You think about fixed income, and that's kind of connected to the cost of capital. Well, options are connected sort of to the reward of volatility. So the more volatility you get, the more option premium is available for any particular risk profile. So it creates a really interesting moment for options-related strategies, options-related ETFs, and options-related traders in order to take advantage of that volatility. And that's sort of the name of the game, I think, as we start the year with a little bit of a rocky road.
Sai, you are also the man behind this ETF, the TSPY. Curious to hear more about that ETF. What's its purpose? What's its mission, Sai?
Yeah, I appreciate it. So TSPY, the goal is we own the S&P 500 long in the underlying. It's a buy and hold product. But one of the things that we learned is that there's an opportunity to take advantage of this new zero-day option capability to sort of harvest additional income for investors in the fund. And so as volatility rate rises, the option premiums that are available to go out and harvest and collect on behalf of investors grows as well. So if you're a long-term investor, short-term volatility you're less worried about, but by turning on this mechanism, you can actually take that volatility and use it to your advantage. And sort of that's the theme behind T-SPY as an ETF. And that's why it's sort of a volatile environment where people are wondering, hey, is fixed income going to help bridge the gap for income? Option-based strategies are a really interesting way to take advantage in order to fill the gap.
And I know in general, covered call strategies have sort of gained in popularity in this environment. Tell people what a covered call is and why right now seems to be a good time for them.
Yeah, covered calls, essentially, it's low to moderate risk strategy. It's one of the only strategies that you're actually allowed to trade in an IRA account. But basically, you own shares of an underlying security. And then you sort of sell the opportunity for someone else to buy that security away from you at a higher price. And so when you do a covered call, you're able to mortgage the value of what you have to collect a little bit of income premium today. And so in flat markets or down markets, it's a really interesting way to sort of hedge downside risk that you have. And if you're expecting that the growth of the capital markets over the next year or so is going to be flat, this is a good way to juice up or take benefit from volatility by employing a covered call strategy to sort of help harvest some income.
The rise in popularity, Sai, of trading platforms has, of course, increased access to options. I'm just curious, Sai, in your opinion, who should be trading options? Who should, who shouldn't? How do you think about that?
Yeah, options can be used. They're a tool, and they can be used in lots of different ways. So, some uses of options are almost like insurance. You can buy an option, and if you want to protect downside risk, that's a way in order to sort of take some risk off the table from the downside. So it really depends on how those are being used. There's uses of options where it's very high risk, where you're writing options, you're selling them, but you're doing it without the underlying security to collateralize it. That's risky, because options move significantly differently than the underlying securities do. So, the option usage needs to match the risk profile of the person using it. So retail investors absolutely can learn about the tool to look sort of hedge different positions. But ultimately, one of the reasons that we loved being able to package a strategy in an ETF is because we're able to create a risk-appropriate product for low to moderate risk investors and manage the process for them. So they don't need to get into the nuances of how to buy and sell options. We're transparent about it, and they can see those trades as they happen every day, but it helps to provide a low to moderate risk way to generate some income without having to get into the complexity of how to manage them yourselves.
In general, though, Sai, we have seen an explosion in options trading. And so I guess I would ask, writ large, are there any systemic risks or risks of people losing a lot of money on a broader scale? Have you seen any of that kind of creep its way in?
It's one of the worries that people sort of mention with this popularity of zero DT options. So 0-day options are ones that are basically expire same day. So they're super short term. And the worry, and by the way, this has exploded in popularity. I think almost half of the options that are traded on the S&P 500 are 0-day options. And a lot of it, that has been driven by the retail market. The worry, though, about how is that going to impact potential movements in the underlying securities, exchanges like CBOE, for example, have a lot of data and statistics around it that say, well, actually, the buying and selling, even though the explosion is there, it's been balanced. And so that's what sort of kept the risk at bay for that exploding into a big market movement where you're going to have a big gap up or a big gap down based on options trading activity. But yes, the explosion has been there, but so far it's been balanced. But that's the risk that people worry about.
Sai, great to have you on the show today. Thank you so much for joining us.
Thanks for having me. Appreciate it.